It is being reported today that Tom Lee is about to raise his S&P 500 price target for the end of this year. But I think one of the biggest headlines today is what Tom Lee said about the S&P 500 over the next coming years. Tom Lee says the S&P 500 will soar 175% to 15,000 by the end of the decade. That's just by 2030. That's not that far away. Nvidia plummeting down over 5.5%. Today alone, we have a lot to talk about. But let's first go over what Tom Lee just said about the S&P 500 heading into 2030. Tom Lee believes millennials and a global labor shortage are the two thematic drivers behind his bullish projection. Tom Lee says, quote, "The two previous instances of global labor shortages resulted in a parabolic move in technology stocks." He says the stock market could nearly triple by the end of the decade. He also says, quote, "I think we try to look at a normalized situation, and in a normalized world, if this is a normal S&P cycle following demographics, S&P should be potentially 15,000 by the end of the decade. To me, as you move into a longer time frame, that's probably where I think we're moving towards." Backing up Lee's bullish projection is continued growth in earnings and the stock market's valuation multiple. Quote, "It's roughly a 20% annual price appreciation. Earnings growth would be 12 to 15% of that total. So then you have a 5% a year PE expansion," Lee said, referring to the popular price to earnings valuation measure. Whether that valuation multiple can grow at a 5% a year seems like a lofty projection, but Lee said stocks deserve the premium valuation, especially following the COVID-19 pandemic. Tom Lee also says, quote, "I think one thing to keep in mind is COVID proved to us that businesses are a lot more resilient than we realized. So why should we assign the same PE to them that we assigned to them prior to this, knowing that if you shut down the global economy, jack up unemployment to 20%, have huge supply chain disruptions, and yet companies could manage earnings? I think they deserve a lot more credit, so I think the multiple can compound at a higher rate than 5%. He says part of our work relies on what we call thematic drivers. One is millennials. Since 2018, we've talked how millennials, which is the largest generation, are reshaping the economy, which they are mainly through fintech and changes in preference. But of course, now coming in is a big generational wealth transfer, as you know, as much as $80 trillion. The second, of course, is that there is a huge global labor shortage, which has started in 2015 and won't be resolved until 2035. And the two previous instances of global labor shortages resulted in a parabolic move in technology stocks. Lee's global labor shortage projection is based on global demographics, with prime age workers not replacing older generations at a fast enough clip. And that means companies will turn to technology and automation to make up for the gap in prime age workers, ultimately spending trillions of dollars on silicon-based technologies that can enable robotics and artificial intelligence. And I gotta agree with Tom Lee. He's correct. And I think maybe he's actually undershooting some of these things. I think the markets can be exceptionally higher than even potentially 15,000 on the S&P by 2030. The reason for this is actually pretty simple. Now, inflation, when you're actually dealing with it, is pretty rough. It slows down nominal growth. It slows down the consumer mentally, where they look at products that were 6 months ago, a year ago, $2, and now they're $4, and they're like, what the heck? And they start buying less. For obvious reasons, inflation is not good, at least in the short term. But what actually tends to happen is a phenomenon where, kind of like if you bought a house in the 1950s for $5,000 and today it's worth $1 million, that's because you've seen a lot of inflation during that time. You've seen wages go up a lot during that time. But the actual price in which you bought your home, a business, a stock for that matter, is fixed. Meaning, for an example, if you buy Dollar General, for an example, at a $30 billion market cap valuation, over time, as inflation happens, as consumers get, used to new prices, as wages go up, if you bought Dollar General at a $30 billion valuation, well, 10 years later, it could trade at a $60, $90 billion valuation, and really that's just because there's more money out there. There's been more inflation. There's wages that have went higher, but you still bought your investment at a $30 billion valuation. You get it? So as inflation rises, people get used to inflation. That can actually start to drive a lot more earnings than what you've seen years prior, but you got to get through the pain of it first. And I still think we're in the part of this inflationary cycle where there's a little bit of sticker shock, a little bit of backlash. And inevitably that will end over the next 12 to 24 months. And that will be another big driver on top of everything Tom Lee said to push markets higher. But I do think in the near term, we are set up for a very large crash. Yes, I think this is an expectation of false realities. I think when you look at AI is a 50-year cycle. It's going to be 50 years of build out into AI. This is a long game. And markets are priced as if all of these returns and these results from your hyperscalers, the companies buying GPUs, are going to happen within the next couple of quarters. And that's not reality. So I think from the AI front, there's way too much good news baked in too short of a time frame. And that's why specifically I've been bearish on Nvidia ever since Nvidia hit that high at $140 per share. And I started warning about Nvidia about 7 days ago now. And Nvidia is, well, currently down about 16% since that first video that was put out here on the channel. Now, I think the question really is what happens to the broader markets in regards to this. The S&P 500 is down about 0.1% at the time of recording this video. The Nasdaq's down almost 1%. So the Nasdaq's obviously taking this day a little bit harder. But I do think there's also a false reality of the expectation of a no landing, soft landing, or hard landing. Meaning, if you look at the S&P 500 and the Nasdaq currently, we're priced as if there's a 0% chance of a recession within the next 12 months. Based on so many different data points that are in deep recession territory, I think the odds should be higher. Even if we don't go into one, I still think the odds should be higher that we could. Maybe 20%, 30%, 40%, 50%, 50%, a coin toss. Sounds more logical to me given CB consumer confidence in deep recession territory. Like, that's never happened before. The unemployment rate just crossed above the 36-month moving average, which has historically led to a large rise in unemployment. Same is true with the unemployment rate going up 0.6%, going from 3.4% to 4%. That has, in the last 50 years, led to a rapid rise in unemployment. Again, things the markets are not even looking at nor pricing in. More recently, we're seeing a rise in the initial jobless claims numbers, and that's not a good leading indicator. You also have 770,000 jobs last year that were overstated, so the labor market's not nearly as strong as we think. You have consumers slowing down on discretionary spending. You have housing basically stuck in a standstill. At the same time, commercial real estate is not doing great at all. Michigan's current conditions for the economy just came in at the worst levels you've seen since the 2008 global financial crisis. You're basically at the same level as you were then. And you also have a Federal Reserve that looks dead set, in my opinion, in causing a lot more economic pain before they start cutting rates. When you put all of these things together, I don't think the odds of a recession should be at zero. That's the part. Like, whether you're bullish or bearish or not, you should be able to sit here and say the odds are not 0% of a recession. What do you think they are? Down below in the comment section. Do you think they're 10% within the next 12 months? Do you think they're 50%? Do you think they're 60%? Where do you think the odds are? Because what I'll tell you is, remember 2022, hopefully most of you guys were invested during that time. If you were not, welcome to the markets, and a very strange market that is. But what happened in 2022 is the odds of a recession just rose. So throughout 2022, you started, 2022 at like 0% chance for a recession, or maybe 5% chance for a recession. You started to climb to 20, 30, 40, 50. By the time you got to 50% chance for a recession, markets were already down 25+%. And then what happened? You ended up going to 100% chance of a recession, and then you fell 35% on the NASDAQ. So that's all. It's as simple as that. I think the markets are a little mispriced and not factoring in the risk that is out there in the markets. Strat says today, Tom Lee reiterates this, quote, "We continue to be constructive on stocks in the near term. In fact, the arguments against breadth in our view are misplaced. Consider 33% of the S&P 500 is up 10% year to date. 24% of the S&P 500 is up 15% year to date. 16% of the S&P 500 is up 20%, and 8% of the S&P 500 is up 30%. That means 40 SPX stocks are up 30% year to date. That is hardly a narrow market. In fact, it's quite a broad-based rally, and counter to those arguing this is only 7 stocks driving returns. But in all fairness, according to their research, 60% of stocks are at a 0% or negative return for this year. I don't know. That's a tough argument to make. If you take a look at the percent of stocks above their 50-day moving average, sitting at 43.11%, almost 60%, 57% of stocks are actually in a downtrend and have been in a downtrend for a while. If you take a look at the start of 2024, when 86% of stocks were above their 50-day moving average, that was a broad-based rally. This has not been a broad-based rally. Could breadth be worse? Of course. There's obviously other stocks performing rather than just your Magnificent 7 names. But beyond some specific AI-adjacent tech AI-adjacent names, there's not that much participation in this market. And based on a market cap weighted basis, yeah, there's definitely narrow breadth. Charlie on X says Nvidia now trades at 21 times forward sales, up from 12 times forward sales 2 months ago. This is a significant premium over Microsoft at 12x sales and Apple at 8x. And you can see that's probably some of the reason why Nvidia is falling today. Valuations just got extreme and Nvidia is correcting, down about 6%. Also, after last earnings, you did not see any kind of correction before or after earnings. And historically, ever since Nvidia gave us that first big quarter in spring of 2023 and really put AI on the radar for everyone, you have always seen an 8 to 15% drawdown before or after earnings for Nvidia. It just didn't happen this time. You also had a stock split that historically leads to an underperformance after the stock split, and that didn't happen either. Nvidia just kept going higher. I actually do think it's pretty good though that Nvidia is down 6% today and the S&P is only down 0.14%. I mean, you are seeing to some degree a rotation into other areas like Apple that's up 1%. Microsoft is down 0.36%. But you do have Meta that's slightly positive today. You do have other stocks that are doing okay. Google slightly positive today as well. It's not a broad-based big tech just catastrophe across the board. And at the same time, Nvidia is down 6%. The Russell 2000 is actually up 0.5%, and the Dow is up 0.66%. So definitely some kind of rotation is happening today. And according to Goldman Sachs, now about 80% of S&P 500 companies are now in a buyback blackout window, meaning right before earnings, companies are not allowed to buy back their own stock. So this could be less buying pressure on some of those names that do a lot of buybacks. What's fascinating today is you did get the Dallas Fed Manufacturing Index that came in much worse than expected on a headline basis. It came in at -15. You were expecting around -12. So that was a pretty bad number. But when you actually break down the survey, it gets very strange. It says manufacturing index 6-month outlook for new orders rose in June to the highest since March of 2022. So new orders are forecasted to do well, whereas the employment outlook went the other way and fell to the lowest since December of 2023. And according to a survey from TransUnion that shows across all generations, a good chunk of respondents have now cut back on discretionary spending. And don't be surprised if we get more of a bleed out in your big tech names, because mega cap tech stocks hit their most overbought level in more than 6 years last week. Trading Thomas on X suggests that professional knife catchers should get ready soon in Nvidia, really saying that Nvidia should bounce here in the 114 to 119 area, which you're there now. And especially after a 6% drop today, it wouldn't surprise me if some buyers do step in here. Worth mentioning, it has been 2 years since Nvidia has had 3 straight 3% plus declines. That was June 9th, June 10th, and June 13th of 2022. Bitcoin is troubling, at least right now. You have fallen under 60,000 and the pain continues. Now, Bitcoin is one of those, I like to say, leading indicators of a broader kind of risk-off market that could be coming. Bitcoin seems to be one of the first stores of value that gets sold. And I put it in value in air quotes because value is going to vary based on anyone. I think Bitcoin's value. I think Bitcoin's going to do very well. Eventually, it's going to hit over $1 million. But not everyone thinks Bitcoin is value. In a troubling sign for global inflation, global freight container rates are still moving higher and on a year-over-year basis are now up 233%. Gurgavin writes on X, Nvidia insiders have now sold more shares in the last 1 month than ever before. Insider buying versus selling in Nvidia over the past month. You have 0 buys and $427 million worth of sells. And we have reported this here on the channel quite a few times. Jensen Huang has been selling a bunch of Nvidia right before Nvidia has now fallen 15%. So insider selling does not always mean that the stock is going to fall, but it can be a good anecdotal point to say in the short term there could be some weakness, and that's exactly what we're getting. And again, to the point that I made earlier in this video, current max drawdown for the conference board leading economic index is now at negative 14.7, which is only consistent with recessions looking back at history. And you could see that here. You're getting pretty negative. You're more negative than you were during the Rona crash, when literally nobody knew how long the economy was going to be shut down. I think that tells you a little bit of you know, there's some worries out there. There's some pain out there. And to put a more precise number on the amount of Nvidia selling, insiders have now cashed out more than $796 million worth this year. A big test for your AI stocks and also what could be big tech will be Micron earnings that will happen Wednesday after the close. Micron has done exceptionally well in recent weeks, hitting new all-time highs, almost tripling since February of this year. So there's lofty expectations there, and if they don't deliver Wednesday, that could mean more pain for Nvidia since the two companies do work together. You also have FedEx that will be important for the overall state of the economy, and on Thursday and after hours you will have Nike, which will be important for that discretionary stock. And you have a Meta insider trading alert. Founder Mark Zuckerberg just sold $12.1 million worth of Meta shares. He has now sold $54 million worth in the last 10 days. After all, when you have a $400 million Hawaiian underground bunker to build, then you probably need to sell some Meta. But that could be another little anecdote of insider selling that could mean some weakness could come for Meta. And really, in fact, you've just seen a lot of insider selling across the board recently. In fact, the most in many years. The VIX is only up 1.29% today, which is actually surprising considering the Nasdaq's down almost 1% and the S&P is even slipping further at the time of recording this video. Like, if I told you Nvidia was going to be down over 6%, where do you think the VIX is going to be on that day? You would probably say up 5 to 10% at least. You're not even up 2%. You're not even up 1.5% on the VIX. So people are fearful, but not that fearful today, which if you are a contrarian could mean more downside to come. We do have data coming out tomorrow morning with Chicago Fed National Activity Index, S&P Case-Shiller home price month over month and year over year. That data comes out in between 8:30 and 9 o'clock in the morning. CB Consumer Confidence at 10 o'clock in the morning. Richmond Fed Manufacturing and Richmond Fed Services data comes out at 10 o'clock in the morning, as well as Dallas Fed Services index that also comes out at 10:30 in the morning. You have Fed Cook that speaks around noon, Fed Bowman that speaks at about 2:10 p.m. as well. 10-year Treasury yields are unchanged today. Your CNN Fear and Greed Index is at 40 today, which is in fear territory. Again, you're probably not going to see this too many times in your investing lifetime, where CNN's Fear and Greed Index is fear, but yet the S&P 500 is still less than 1% off of all-time highs. Typically, if you're in fear, you're in like a 5+% drawdown already, and that's just not where we are yet. You do have TLT up 0.2% today. You also have the dollar up 0.23% today, and oil that is up 1.23%. Oil and the dollar being up, not exactly great for stocks. TLT being up is good. So let me know what you think about all of this information down below in the comment section. Do you think this drop in Nvidia is going to be bought up? Do you think the rest of the markets are going to follow suit with Nvidia falling and now Bitcoin falling? Some of your most risk-on assets falling first can be a sign of more downside unless they do get bought up, or you do see a broader rotation of that money going into other areas of the market, which does seem like it is happening now. So let me know what you think about this information down below in the comment section. What do you think about Tom Lee's longer term projection for the S&P 500 as well? Again, you never want to bet against the US economy in the short term, but there can be large, unforeseen, and significant drawdowns in equities between now and then. You guys have a great rest of your day. Hit the like button. Consider subscribing to the channel as well if you made it to the end of this video. Most importantly, enjoy the rest of your day, and I will see you in the next one.